A dusty attic, a forgotten lottery ticket, and your 401k. What do they all have in common? They could be hiding a treasure. Most people have never heard of NUA, but for some people, it's the difference of paying 37% in taxes or very little at all. NUA, net unrealized appreciation, is one of the rare IRS loopholes that actually rewards you for being loyal to your company stock. It's sitting in your 401k, quietly waiting to save you thousands, if not millions. So let's unlock what an NUA is and some essential planning tips if you're considering the NUA strategy. But first, I'm Gabriel Shahin, Certified Financial Planner, and I'm here to simplify planning, grow your knowledge, and help you get richer. The NUA rule might just be the most powerful tax break hiding in plain sight. Let's start with the basics. If you've worked at a company for a while, you'll probably have a 401k, and inside it, you might have your employer stock as an investment option. Maybe you bought these shares through your employee stock purchase plan, or your employer matched contributions of company stock inside your 401k. But when you retire or separate from the company, the default move is to roll over your 401k into an IRA. The problem is, if you do that with your company stock, you might be throwing away one of the best tax opportunities in the IRS code, which is that NUA. It simply means the growth in your company stock that hasn't been taxed yet. It's the difference between what you paid and what it's worth today. So let's use an example. Say you've been at a company for 25 years. Over time, you've accumulated company stock in your 401k. You originally paid, let's say, $100,000 for those shares. That's your cost basis. Today, let's say that company stock is worth $1 million. Most people just roll the $1 million into an IRA. Later, when they withdraw, every dollar is taxed at ordinary income. That's the same rate you pay on your paycheck, which is up to 37%. But the NUA rule gives you another option, and this is where it gets powerful. Instead of rolling the company stock into your IRA, you could take it out of the 401k and move it into a regular taxable brokerage account. You'll only pay ordinary income tax on the $100,000 cost basis. This is the amount you originally paid for the stock. The remaining $900,000 in growth, that's your net unrealized appreciation. It isn't taxed yet. And when you sell it, those shares, that portion is taxed at long-term capital gain rates. That is either at 0%, 15%, or 20%, depending on your income. That's a massive difference. You could cut your tax bill nearly in half by just structuring the rollover correctly. However, not everyone could use this strategy. The NUA rule only applies to company stock inside an employer-sponsored plan, like a 401k or an ESOP. And you can only trigger it when these events happen. You either leave the company, retire, terminate, or change jobs, you become disabled, or you just pass away. In that particular case, the beneficiaries can use it. And here's the key. You must take a lump sum distribution of your entire 401k in one calendar year for the NUA to qualify. That means all assets, not just the company stock, have to leave the plan. Most people mess that up by rolling part of it into an IRA first and completely destroying the NUA benefit. Let me explain. Let's go back to our first example. Option one is you roll the $1 million into an IRA. Withdrawals later get taxed at ordinary income, let's say 35% tax bracket. So you pay $350,000 in taxes. Option two, you use the NUA strategy. You pay ordinary income tax just on the $100,000 of basis. Maybe that's in the 24% tax bracket, which is $24,000. Then, years later, when you sell the shares, you pay long-term capital gains on the $900,000 of growth. Say that's in the 20% tax bracket, or in this case, $180,000. Your total tax is $204,000, leaving you with $146,000 in savings, which is almost equivalent to a 15% savings. Same stock, different strategy, better outcome. Now, I tend to come across some common misconceptions when it comes to NUA. Some people ask, doesn't that mean I have to pay the tax right away? Yes, but it's only on the cost basis. Now remember, the goal isn't to avoid taxes forever, it's to pay less tax overall. You are converting high-rate ordinary income into low-rate capital gains. Another question is, can I do this with any investment? The answer is no. Only company stock held inside your employer's plan qualifies. What if the stock goes down? Well, if there's little appreciation, then NUA may not be worth it. But if you held the stock for decades and it's appreciated substantially, you'll be shocked at just how smart the move was. It's one of those rare times where the strategy, timing, and patience actually pays off. But understanding why it works is only half the battle. Here's some of the key planning tips if you're considering the NUA strategy. Tip number one, don't roll anything into the IRA until you've talked to your tax professional. One wrong move can disqualify your NUA eligibility forever. Tip number two, be mindful of your current tax bracket. If your cost basis is high and you're in a high income year, it may not make sense to trigger the NUA yet. Tip number three, diversify once you transfer the stock. You don't have to hold onto your company stock forever, just long enough to get the long-term capital gains treatment. Tip number four, remember the step up in cost basis rule. If you hold these shares until death, your heirs could get the full step up of cost basis, wiping out capital gains entirely. Let me share a real world example. A client retired from a Fortune 500 company with $1.2 million in their 401k, about half in company stock. Their cost basis on the stock was roughly $25,000, but it was worth $600,000. If they rolled everything into an IRA, all future withdrawals would have easily been taxed at ordinary income rates, which was 24% or higher. Instead, we applied the NUA rule. They paid ordinary tax on that $25,000 cost basis. The $575,000 in appreciation became long-term capital gains, and they saved over $90,000 in taxes and gained flexibility in managing their retirement income. Now, NUA isn't for everybody. If your company stock hasn't grown much, or if the cost basis is nearly equal to the market value, there's a little benefit. It can also complicate your portfolio. If you already have too much exposure to your employer stock or a specific sector or asset class, like any tax strategy, it has to fit within a bigger picture. So here's the bottom line. The IRS tax code is full of traps, but also opportunities. NUA is one of the few strategies that actually reward loyalty and smart planning. If you have company stock inside your 401k, don't blindly roll it over. Understand the cost basis, calculate the potential tax savings, and work with a professional before making the final move. Because once you transfer that stock into an IRA, this opportunity is gone forever. If you found this video helpful, watch our next video as it's full with strategies that help you achieve your financial goals.